Good day, Great Golf learners. My name is Mr. Simbi, and welcome to yet again another interesting lesson in accounting. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. It is always a joy to have you in my class, and we are going to do interesting calculations as usual again today. So today I'm going to be focusing on financial statements. Remember what I did last week. Last week I also did the statement of comprehensive income, and I touched on some notes to the statement of financial position. Next week I'm going to be focusing fully on the statement of financial position. In a way, we have started it because I've been doing notes to the statement of financial position. The next week we're going to prepare a full statement of financial position. So I hope that you have the answer book, you have the answer sheet. There is a worksheet that was sent to your teacher, so just make sure you check with your educator if you have this worksheet, and then if you have printed it, it makes it easy because you are able to write as I write together with you. So make sure you have your calculator. That is standard procedure. You must always have a calculator with you. So make sure you have a calculator, you have a pencil, you have somewhere to write. That is very important. If you have those things, then we can begin. To begin with today, I have this question. These are questions that we find very often in these question papers, and I encourage you to go through these questions as you can pick easy marks from these questions. So in this one, it says choose the correct words from those given in brackets, right? Only the word or words next to the question numbers. And then we have 1.1.1 up to 1.1.3. The first one reads, unused consumable stores. So we have unused consumable stores at the end of the financial year are classified as, so you must choose between current assets and financial asset. Definitely it is your current assets. When you talk about your financial assets, we're talking about things such as your fixed deposit that is said to mature in more than one financial period. So that is what your financial assets are. So the answer here will be your current asset. The second question then reads, interest on loans is regarded as operating activity or financing activity. This is interest on loan. So interest on loan is your financing activity. And then the last one is the directors or the dash report reflects a verbal explanation of the company's activities and future plans. So I think I had already gave that one away. It is your director's report. Remember your audit report, you have those three different types of audit report. That is your unqualified, your qualified, and your disclaimer. Next week, I'm going to bring an activity that also speaks to audit reporting. So if you have an issue with audit reporting, make sure next week you join the class so that I can explain those few aspects. Okay, so I think here you're supposed to fill it in here, but already I showed you the answer. So 1.1 is going to be your current assets. 1.1 is your current assets here. And then 1.1.2, that was your financing. So here the answer is financing. And then that is financing activity. And then the last one is the director's report. So you come here onto 1.1.3, then you say director's report. It is the director's report like that. Okay, let's move on to the next one then. This one is the first activity where we're going to do calculations, and it is adapted from the Free State Prelim for the year 2023. Okay, so I want us to go through this together. There is some interesting adjustments. Maybe you've done it before, but it is very important that we go through it together so that you can remember some of the things if you have already done them. Okay, so let us then begin. It is very important that you read your information and understand. One of the things that you need to get when you read. So we are preparing this even for the June exam, for the prelim, and even for the final. I know some of you have already written your control test, or if you're going to write maybe in the next couple of days. It is very important that you read your information, understand your information. Like in this one, it's Tutukani Limited. The information relates to Tutukani Limited. The financial year ends on 28 February 2023. Very key. Very important. So all the calculations that we're going to be doing, we have to remember that the financial year ends on 28 February, the year 2023. Okay, and then, so I have not flagged the entire question. I'm already starting to do calculations. But on your answer sheet, you will find that this information is already appearing. You have your list of balances, you have your balance sheet account section, and you have your nominal account section. So we know that when we prepare our statement of comprehensive income, where do we focus? Is it the balance sheet or the nominal account section? Our focus is on the nominal account section. That is where we are going to get much of our information. So it is very important that when you do this, focus on your nominal accounts section. So let us then go. Here is our statement of comprehensive income for the year ended 20th February 2023. And then we begin off definitely with our sales. So I'm going to come here and I'm going to say sales over here. And then I am given cost of sales. So I'm coming here and I'm saying cost of sales. And then that should give me what we call gross profit over here. This is my gross profit down there. Now, before I even put anything, I know this from grade 8, grade 9, grade 10. In grade 11, we did this several times, that my cost of sales is 100%. So I have 100% over here. Then let us see then what other information are we given. Adjustments not yet recorded. So these are adjustments that we have not yet considered. Let's read them and understand. And I'm going to point out to the key word that you must take heed of, so that when you do adjustments, you can really see, oh, this is the tricky part. Oh, this is the part that I need to take heed of. Okay, number one, it says, goods are sold at a markup of 80%. This is very important. Goods are sold at a markup. So that markup, that is my profit. So I'm going to come here and bring it here, 80%. That means my sales here, it's going to be 180%, like that, 180%. And then what am I given? I'm given my cost of sales. All right, so that is already in your answer book, 1,845,000. Now, I need to get my sales. So I'm coming here, I need to get my sales. So I know that what I want is the 180%. You can see that 180%. That is what I want. So I want 180. And my have must have two values. So I have the 1,845,000 and the 100%. That is what I have. So I have 100 and I multiply that by my 1,845,000 like that. Okay, let's see how much it's going to give us. Let's see how much it's going to give us. So let me just close the bracket. And then we're here now. All right, let's bring this friend of mine here. So I'm saying what I want is 180 and what I have is 100. And then I'm going to multiply this by 1,845,000 like this. And then it should give me an amount that is 3,321,000. So I'm coming here and I'm going to say 3,321,000. I am putting it here because I have read this part which says discount for damaged goods sold during the year amounted to 14,600. Then I'm going to come in, I'm going to say minus 14,600. So that is discount for damaged goods. So I'll come here then, I'll say minus my 14,600. That is the discount for damaged goods. And then I'm going to end up with 3,306,400. So I'm coming here, it's going to be 3,306,400 like that. Remember, your cost of sales is in brackets, and then you are going to end up now with your gross profit. So it's my 3,306,400, and then I subtract the 1,845,000 like that, and then I'll end up with 1,461,400. 1,461,400. That becomes my gross profit. Very important. Now, you will see that on this area of your statement of comprehensive income, there's quite a number of adjustments that an examiner can bring. So it is very encouraged that you do as much practice in this particular area as possible, where there's trade discount, where there are invoices not recorded. And here we did the one for discount for damaged goods. So I want to encourage you, dear learners, that you work in this area and see what else can be done in terms of calculations. And also take heed that at times the examiner can come having shaded this particular area. That means they don't want us to do these particular calculations. But if you are given, make sure you do these calculations perfectly well. Can I move on to the next aspect then? Let's do that. All right, so the next adjustment is on stationery. All right, it reads, stationery to the value of 22.6 was used. So I know that my stationery falls under my operating expenses down here. So I'm going to come here and I'm going to open a bracket and I'm going to say stationery. And I'm going to now, here's my bracket, and I have my 24,684. This is from my list of balances under the nominal accounts. Then I am told stationery to the value of was used. The key word is used, because we know that here we're going to show the amount that we have used. Our expense for the year is what we are looking for. So the examiner has, in this case, given us the 22.6, which was used. So the used amount is what I bring here, and that is my 22,600. I bring it here in this last column. That is what was used. So if that is what was used, how much was on hand then? All right, so it therefore means I'm going to come and I'll say the 24,684, the 24,684 minus what was used, which is 22,600. It gives me my 2,084. So I'll come here, then I'll say 2,084 is what is on hand. 2,084 is what is on hand. So I'll close this one like that. So this is one way that the examiner would have given it, where they say stationery to the value was used. But the examiner can also say stationery to the value of 2,084 was on hand. Then they say at the end of the year, that is on 28 February 2023. So what they're simply saying is we have acquired stationery of 24,684, but we did not use the entire 24,684. We still have some on hand. That amount on hand, you would come and then you would subtract it from here. So you have this particular adjustment, which can be asked in these different ways. Number one, you have what was used. If you're given the used, you bring it here into the last column. But if you have on hand, you come and then you subtract the on hand. And you know that that 2,084 is going to go to your note number 4 for inventory. Your note number 4 for inventory. Are you still with me? And then it depends on how the examiner would want you to record that. But in this case, we were just bringing it over here as our stationery that was not used. Can I move on to the next one? Let's go on to the next one. And then it says, included in the amount for insurance was a yearly premium. Okay, so this one is now referring to insurance. This one is referring to insurance. And we're told that it was a yearly premium of 5520 paid on 1 December 2022 for the year ending 30 November 2023. So here I can draw the timeline so that maybe we can have a clear understanding as to where we're coming from and where exactly are we going. Our financial year, we know it ends on February 2023. So if it ends in Feb 2023, it means it began on the 1st of March 2022. So this is our 12 months here. Okay. And then we are told in the amount here of insurance, which I would have come here and I would have said insurance. and then I would have opened my bracket and I would have said insurance 46,500. And included in that amount is a yearly premium of 5520, which was paid on the 1st of December. That means I'm going to come here and I'm going to say on the 1st of December 2022, we paid an amount of 5520, which is a yearly premium. Okay, that means it's going to stretch from the 1st of December and it's going to end all the way onto 30 November. Okay, onto 30 November, that is now in 2023. Now, we have a problem because the financial year is supposed to end on 28 February here, but we've paid until 30 November. That means we have a time here where we have paid for an expense in advance. That is our issue. When you pay for an expense in a period in which we have not yet entered into, we call that a prepaid expense, an expense that has been paid in advance. That cannot be recorded in this particular financial year. It belongs to that next financial year. So what we need to do is to take it out. We take it out. So what we want to do first is to know for how many months did we pay in advance. So we're going to count from March, which is over here. So we're going to say from March, April, May, June, July, August, September, October, then November. So we have 9 months here that we have paid in advance. And so we are now going to say the 5,520. So it's going to be your 5,520. And then we're going to multiply that by the 9/12. We want to see how much was paid in advance. So let's get the machine again. So we're going to say it's going to be 9/12. All right, let's bring it back again. So it's going to be 9/12, 9/12, and then we multiply that by 5520, and then that is going to give us 4140. So I come here, that's 4140. That is my prepaid expense. I must adjust this in the income statement as well as in the balance sheet. Okay, so in my income statement, I'm coming to say insurance. I have a prepaid expense of 4140. So I'm going to subtract that 4140. That is a prepaid expense. So I subtract it. I've removed that. But I also know that once I've paid an expense in advance, it must go to trade and other receivables. That is a prepaid expense. So I'm just going to come here under my trade and other receivables, and I'm going to say 4140. Okay, so there was a bracket here. I'm just going to have my 4140 down there. We good? Okay, let us then continue. All right, here we are. The next adjustment has to do now with salaries. If you feel like, Mr. Simbi, you're a bit fast, slow down. You just tell me, Mr. Simbi, please slow down, and then I'll do so. Okay, but I'm going to try to do it a bit slower so that you can also be able to write. I want to give you a chance to make calculations as well. So the next one says, one worker was not paid his salary for February. His details are as follows. I've seen several adjustments that pertain to salaries. I've seen one whereby the employee was paid double. I've seen different. Make sure that before you sit for your test, you do go and practice on these particular adjustments that will enable you to be able to write your test properly. So it says one worker was not paid his salary for February. His details are as follows. So here are the details. There are the details, and let's see what they want us to do. We are to record in the statement of comprehensive income. So let's do the first thing. Always remember, we open brackets. So that means I'm coming here and I'm saying salaries and wages, and I open bracket, that is 360,500. All right, we're going to take a quick 2-minute break, and immediately after the 2 minutes, we're going to continue with our salaries and wages adjustment. Welcome back, guys. I wanted to give you the opportunity to try this adjustment out on your own. I hope you were able to do some calculations on it. Okay, so remember what they said. One worker was not paid. One worker was not paid his salary for February. So that means the other 11 months were recorded and paid, but it is only his salary for February that was not considered. And then the details are as follows. It is very important to note that if I have a gross salary, if I have my gross salary and then I don't know the amount, then I subtract deductions. My deductions in this case is 5.6. And then I will get what is called net salary, which is 14,500. So it simply means if I want my gross, it's simple. I just go all the way up. All right. So if I want to get my gross there, I'm going to say 14.5 plus the 5.6. That is going to give me 20,100. So this becomes 20.1. That is my gross. And that gross salary, we take it to the income statement. So I'm going to come here and I'm going to say 20,100. Then someone says, but Mr. Simbi, why can't I just say plus 5.6 plus 14.5? You'll still be right and you can be marked there. Okay, if you put a 20.1, you're still very, very right. Okay, and then they then tell us contributions are recorded in the salaries and wages account. So this is very important to note that in this particular question, the contributions are recorded in the salaries and wages account. So we're going to come here and we're going to say plus 3,800 plus 3,800. And then you can close this off on your own. Okay, so this is a salaries and wages adjustment. You've seen one where they can bring percentages. Please work on such as well, where they can say the gross is maybe or the net salary is 70% or the deductions are 20%. Work on such adjustments so that you can be exposed to how they must be done. And I think in the previous week we did do an adjustment like that. So if you missed last week's class, I want to encourage you, go back and watch that class so that you can see how we did that adjustment. Let's go on. Rent adjustment. Rent was received until 30 April. So the moment you hear this, in your mind, remember, you have to read the question and understand. When we began, I told you there's very important information that you must pick the moment you read a question. What was one of them? The financial period. When is it ending? 28 February. So it means it began on the 1st of March, 2022. And it ends on the 28th of February, 2023. Very key. Okay, but then we are told that rent was received until 30 April. So it means we're coming here to 30 April. This is now in 2023. Very key. Let's see what it is that we are required to do. We are to prepare the statement of comprehensive income, and then obviously I'll talk to you about where we record it in the statement of financial position. So if we had received rent from March to February, that is our 12 months, there was no problem because it's within this particular financial period. But the moment we receive money for the next financial period, we call that income received in advance. We were not supposed to receive that income because we are not yet in that financial period. We're supposed to receive for these 12 months. So the moment we receive that particular amount, we must take it out. How many months did we receive in advance? So remember, here is 12 months. How many months is it from March? Remember, you don't count February because it's 28 February. So you start counting March, April. So how many months is that? That is 2 months. So you receive 2 months. So in total, for the year, we've received 14 months worth of rent. Now, I'm going to do something and I'm going to ask you why that is wrong. Let's suppose I take this 92,736 and I say, let's divide it by 14. Will that be correct? No, that will not be correct. Why? Because the rent was not the same for the entire 14 months. The rent increased. for a part of the year. When did it increase? From the 1st of November. So I'm going to come here from the 1st of November. From 1 November 2022, the rent went up by 12%. So it therefore means, how many months is it? From the 1st of November until the 30th of April. Let's begin to count now. So we're going to say November, December, January, February, March, and April. So we're sitting with how many months? 6 months. Okay, so here we go. I know that I have paid for 14 months. I know that I've received for 14 months. I've received for 14 months. So if I start from the beginning of the financial year, it would be from March, April, May, June, July, August, September, October. All right. For these 8 months, rent was the same. So if rent is the same, we consider it to be 100%, because we're told here it then increased by 12%. So for 8 months, it was 100%. And then for the other 6 months, you remember we counted the 6 months. So for the other 6 months, it increased to 12%. So by 12% rather, to make it 112. So I'll come here, then I'll say 8 by 100, that's 800 over there. We're still good. And then we say 6 by 112. That gives you, let's see the adding machine. So it's going to be 6 times 112. That's going to give me 672 here. 672. Let's add that together. Then I'm going to say 672 plus 800. And that is going to give me 1472. So I'm coming here 1472. Okay, this is therefore equal to this amount now, which is 92,736. Okay, what is it that we want? We want rent for these 2 months. Remember the months that are beyond February, which is March and April, the months after February, March and April. So I want for these 2 months. But for these 2 months, are we paying the 100% or we are paying the 112 after it has increased? We are paying the 112. So it is 2 months with an increase. So it is 2 times 112. That is now going to give me an amount that is 224. So the rent that we have received in advance is the 224 over what I have, which is 1472. And that 1472, remember, it is what I want over what I have times what I have. And my have in rands is 92736. That is going to give me now the amount that I've received in advance for the 2 months. So I'm coming here and I'm going to say 224, and I'm going to divide that by 1472. And then I'll come here and I'll say multiply that by 92736. 92736. And then I'm going to end up now with an amount that is 14,112. So 14,112. This is the rent income for the 2 months. So I'm going to come here and I'm going to say rent income. I open my bracket and I say 92,736. Then I subtract, because once I receive in advance, I can't record for 14 months because I must record only for this financial period, 12 months. So I must take the 2 months out, and those 2 months are 14,112. Then I close my bracket over there, and I think it will leave me with 78,624, like that. That becomes my rent income. Okay, so I know there's quite a number of ways in doing this, a number of ways in which one could have done this particular calculation. But for this particular question, we were thinking it would be easy if we can do it in this way. Let's go on to the next adjustment then. Okay, so it's income received in advance. In the statement of financial position, where do we record it? Trade and other payables. Very correct. Trade and other payables. It is indeed a current liability. All right, let's go on. And then we are here now. So we are told we are to record in the statement of comprehensive income, we are told the fixed deposit at Westside Bank was increased by 40,000 on 1 June at an existing rate of 8%. So the rate is still the same. The transaction was recorded. Very important, this aspect, that the transaction was recorded. The transaction was recorded. So once the transaction is recorded, you have to know that it is in this 180,000. So there's a number of ways in which one would have done this calculation. Let's do the simplest one. It is to consider the 140,000. I would know that the 140,000 was there from the beginning of the year until the end of the year. So I can calculate its interest separately. Okay, so let's come here and say interest income. Here it is interest income, and I'm opening my bracket. Interest on fixed deposit, remember that is the 12,400 over there. And then we are told to make provision for the outstanding interest. So I'll say the 140,000, which is this one here, and I'm going to multiply that by my 8%. And I know that this fixed deposit was there for 12 months. So multiply by 12 over 12. So I'm going to come here and I'm going to say 140,000 multiply by 8%, which is 8 over 100. And then we multiply that by 12 or by 1. Okay. And then that is going to give us 11,200. Okay. So that is my interest here. That's 11,200 over there. And then it then increased by 40,000. So I'm coming here now and I calculate the interest for the 40,000, which is 8 over 100. And then how many months was it increased? It was increased on the 1st of June. So I'm going to count from June, July, August, September, October, November, December, January, February. Okay, so I have my 9 over 12 months. So I would say multiply by 9 over 12. Let's see how much that is going to give us. So I'll say my 40,000 multiply by 8 over 100, 8 over 100. Then I'm going to multiply that again by 9 over 12, 9 over 12, like that. And that is going to give me 2,400, 2,400. So in total, the interest that we must be having is 11,200 plus the 2,400. So I'll come here. It is the 2.4 plus the 11,200, like that. That's going to give me 13,600. So we must be having 13,600. That is my interest income. So I'll come here. It must be 13,600. But presently, it is 12.4. That means I must come and add. How much must I add? I'm getting the difference between 13.6 and my 12.4. That is 1,200. Then I close bracket like that. That gives me the interest that is outstanding, the 1,200 accrued income that should go to your statement of financial position under your current assets, receivables. Okay, can I go on to the next one? Then the next one, we're coming here now. Directors. This is a very common adjustment, a very common adjustment. Okay, I'm sure if you've written your control test, you must have found an adjustment like this. If you have not, definitely you might find it. So it is very important that you work around these directors' fees adjustment. It says the company has 4 directors. Okay, so let's just say here is director number 1. Okay, there's director number 1, director number 2, director number 3. So the company has 4 directors. So here's the 4th one. Okay, here's the 4th one, 4 directors. Each one of them received the same monthly fee. 2 directors received the fees for the whole year. So for the 2 of them, they received 12 months. So this received 12 months, that received 12 months. Okay, and only one received for his 9 months. And this one received 9 months. And one is already received for March. So remember, it must end in February, but one is received for March. That means 1 month more. This has been paid in advance. So we're talking 13 months. So if we're to add in total, how many months have we paid for all our directors? So we're saying it's going to be your 12 plus the 12 plus the 9 plus the 13. In total, we've paid for 46 months. So in total, we've paid for 46 months in total. Now, you will now say, if we have paid 276,000, and in total we've paid for 46 months, how much are we paying per month? That is what we want to get to now. So it's going to be your 276,000 like that, and we divide by 46. 276,000 divided by 46. That will give us 6,000. That means per month, it's going to be 6,000 per month. Okay? Now, 6,000 per month per director. 6,000 per month per director. But we have a situation with this guy. We paid him 9 months, so we owe him for 3 months. So that simply means with the first director, it must be the 3 months that we owe him times 6,000. That means we owe him 18,000 like that. So I'm going to come here and I'm going to say director's fees. I'm going to say director's fees. And I'm opening my bracket and I'm going to say 276,000. And we have one that we owe 18,000 plus 18,000. And then we have one director that we've paid 1 month in advance. That means we've paid him 6,000 in advance. So I'll come and say our prepaid expenses must be subtracted minus 6,000 like that. And then I close my bracket. That should give you around 288,000 like that there. All right, let us continue. Let us continue. I'm going to go on to the next one and the next one. All right, so you would do well if you can find more adjustments that have to do with directors so that you can practice on these ones. Okay, so the next one is on audit fees. All right, on audit fees. And it reads, 25% of the audit fees are still outstanding. 25% of the audit fees are still outstanding. So that means I'm going to come here and I'm going to say audit fees. Then I open my bracket and I have 24,600, which is my audit fees. But 25% of these are still outstanding. So how do I get that 25%? What does that mean? It means this one is 75%. It means the 24.6 is 75%. What do I want? Here, we must have the entire amount, the 100%. So there is a number of ways in which one could have done this. You could have said 24.6, multiply that by 100 over 75, and then you close your bracket. So you are simply saying here 24.6, multiply that by 100. You want the entire amount, but you know that you have 75. Divide by 75, and that is going to give you 32,800. So you come here, then you get 32,800 over there like that. That is one way in which you could have done this. The other way was to say your 24.6. Now, let's get the 25 that is outstanding, but you know that this is 75. Okay, so it will be 24.6. Let's get that 25. And what we have is the 75. That is going to give us 8,200, 8.2. So you'd be saying 24.6, and then you add your 8,200, and then that will give you your 32.8 like that. So that is how you would still do this particular calculation. Okay, are we good? All right, and then whatever is outstanding, it will go to trade and other payables. This is a liability. This is an outstanding amount. So it will go to your statement of financial position in that case. Let's go on again to another one. It says, okay, remember we had to do it in the statement of comprehensive income, and I can see we're also going to do it under our trade and other receivables. Bad debts recovered, debtors control. The adjustment reads, 1,670 was received from a debtor whose account was written off the previous year. Okay, so I think last week we had an adjustment of this nature, and I explained it again. Okay, the amount was recorded in the debtor's control in the CRJ. Correct the error. So the moment an amount that was previously written off as bad debts is received, it must not be recorded under our debtor's control because we've already written it off. So they're telling us that the amount was recorded in the debtor's control in the CRJ. That means if I'm to look at my debtor's control, here's the plus, here's the minus. We recorded it in the CRJ. Your CRJ would be here. So we recorded it on the credit side. Then they say correct the error. That means we subtracted it from our debtor's control. To correct that, what you're going to do is that money, we call it bad debts recovered. So I'm going to come here and I'm going to say this is bad debts recovered. And I open my bracket and I have my 3,850. And I'm going to now say the amount was 1,670. I record it here plus 1,670. And then I would come now to my debtors control. To my debtors control. And I would now say on my debtors control, the 458,650, that is my debtors control. But I have incorrectly subtracted an amount that was not supposed to be subtracted. So I'm going to come and add it back. That is my 1,670, like that. Okay, that is the quickest way to correct this particular error. Let us go now to the next adjustment. Provision for bad debts must be adjusted to 9,360. So the key word here is the word to, adjusted to. Okay, let's see what we are given. We are to adjust it in the statement of comprehensive income and the statement of financial position. So in the statement of comprehensive income, it must be adjusted to. The easiest way is to check whether we have an increase or a decrease, taking into consideration that an increase is an expense and a decrease is income. But how do we know? We would say the provision amount subtract the adjustment, or rather we simply say the last year's amount, which is the 2022. Okay, last year versus this year. Last year it was 9,820 and this year it is 9,360. What is it? It is a decrease. So we're looking at income. How much are we looking at? It is going to be 9,820. 9,820. Okay, 9,820. Then I'm going to say minus 9,820 minus 9,360. And then I'm going to end up with 460. So here I'm going to get 460. And that 460, that is my provision for bad debts adjustment. So I'm coming here and I'm going to say provision for bad debts adjustment. All right, I open my bracket and it's 9,820 minus 9,360. And then I get my 460. That is income because we have a decrease. And then here I can close this bracket. Remember, I have my 458 and my 1,670. So I'm going to end up with 460,320. Then I bring my provision for bad debts adjusted to. So I say provision for bad debts, I'm going to subtract that. That is my 9,360, like that. And then I would end up with an amount that is 450,960. And we call that our net trade debtors. That is our net trade debtors. Our net trade debtors. Okay, I'm going to quickly move on to the next one now. I hope this makes sense, what I've just explained here. So let's quickly go on to the next aspect. It says, the loan from Westside Bank was taken out on the 1st of July. The loan will be repaid over 10 years in equal monthly installments. Repayments were made from the end of July and all payments were recorded. So we need to know, when did we get the loan? And this adjustment is a balance sheet adjustment, statement of financial position, because here there is no interest, it is simply the loan. Let's do it together. The key is to get when the loan was received. So the loan was received on the 1st of July in the year 2019. So we'll say from the 1st of July 2019, and every year the year ends on 28 February. So it's going to end on 28 February. That is now the year 2020. How many months is that? So you're going to count from here to there. You're going to get your 8 months here. And then the next year then begins on the 1st of March 2020. But this year ends now on 28 February 2021. And this is going to be your 12 months. And again, the next year begins on the 1st of March 2021 and it ends on the 28th of February 2022. Remember, that is your 12 months again. And then the last year ends on the 1st of March 2022, which is where we are now, which ends on 2023. 28 February 2023. That is another 12 months. So in total, you want to know how many months have we paid. If you add these months, you get your 44 months. But we are told that the loan is to be repaid over 10 equal monthly installments. So it's 10 years and each year is 12 months. That means we must pay for 120 monthly installments. So out of the 120 monthly installments, we've already done 44. That means we are owing 76 monthly installments. So if we're owing 76 monthly installments, yet the loan is 760, that means I'm going to say 760 divided by 76. That means monthly we are paying 10,000. When I come under my non-current liabilities, under my long-term loan, I only need to record a loan that is going to be 12 months and more. Any loan that is going to be paid within the next 12 months, I take it out and it goes and becomes a short-term loan. So I'm going to come and say my 760,000 here. I'm going to subtract my 10,000 times the 12 months for the next financial year. That gives me 120,000. So I come here, 760 minus 120,000 like that. And then I'm going to get my 640,000 like that. Okay, that is a statement of financial position adjustment. The next one then reads, income tax is calculated at 30% of the net profit before income tax. And then we are to record here. I know that my net profit after tax is given. And I have my net profit before tax, which is 100%. And my income tax is 30%. 30% here. So here it becomes 70% there. I want my income tax. Okay, so I'll say what I want is 30. What I have is 70. Multiply by 422,450, like that. So I'll come and I'll say, let's bring it over here. I want 30. I have 70. And then I multiply that by 422,450. 450. And then that is going to give me 181,050. Okay, that's my income tax. 181,050 in brackets. 181,050. How much is my net profit before tax? There is a number of ways in which one could have done that. You could have started with the 422,450, 422,450, and you're calculating going up, and then you're going to say plus 181,050. Okay, and that would have given you 603,500. So it becomes 603,500. That is one way. The other way, you could have simply said what you want is 100 and what you have is 70 multiplied by the 422,450. It would have still given you the 603,500. Now, the moment we have our income tax for the year 181, yet our provisional tax payments are 186. So it simply means we have made provisional payments of 186, yet the income tax that we must pay is only 181. That means we've paid more than what we should have paid. So it goes to the statement of financial position under your current assets because you have paid 186, yet the income tax that is due to be paid to SARS is only 181. So that means we have paid more than what SARS required. Therefore, SARS in this case owes us. So I'm going to come to my trade and other receivables, and I'm going to have now my SARS income tax, and I'm going to have my difference, which is 186,000, which is 186,000 minus 181,050. That is going to give me 4,950. So it's going to be 4,950 like that. Okay. Let's go on to the next one. So income tax is calculated at 30%, and then we're coming to the retained income. In the retained income, remember you're calculating your net profit after tax. So if you're doing your retained income, you know that it is net profit after tax that you need here. So already we have that one, which is 422,450. And then after that, you come to your repurchase of shares. So I'm going to come here and I'm going to say repurchase of shares. Repurchase of shares. And I'm going to open my bracket to get the repurchase of shares. I know that it was 12,000 shares that were repurchased. But how much did we pay? It says it was repurchased at 7.30 Rand. Do we record that? No, because we have shares that were issued at the beginning. So it says the share capital consists of 2 million shares that were issued. 1.2 of these shares were issued at 4 Rand. So I can open a mini note number 7 here, all right, where I say on my issued shares, I had 1,200,000 shares that were issued at 4 Rand each, and that will give me 4.8 million. That is at the beginning. Then they say the rest of the shares were issued at 6 Rand. So the rest to make it to 2 million, the rest is 800,000. So it's 800,000, and these are being issued at 6 Rand. That will give you again another 4.8 million. So you then see the repurchase comes after this. Okay, so the repurchase comes after this. So for you to get your average price, you're going to add these two parts and those two parts. So it's 4.8 plus 4.8, that gives me 9.6 million. So 9.6 million I divided by 2 million shares. 9.6 million rands I divide by 2 million shares. And then on my calculator, let me see how much I'm going to get. So I'm going to say my 9.6 million I divided by 2 million. That is going to give me 480. So I come here, that is my 480. So if I am to do that triangle, I know that my ordinary share capital is here, that is 480. And I know that the repurchase price, the total, that is my 7.30 Rand, which goes to the cash flow statement, is over there. So the amount above, or the difference, comes here. So it's going to be 7.3 minus 4.8. Okay, that becomes 2.5. That becomes 2.5. So I'm going to come here, then I'm going to say 12,000 multiplied by 2.5. And then that gives us 30,000 over there. 30,000. Okay, so that is how you'd have done that one. Then the next part of the retained income is obviously going to be your dividends. So I'm going to start first with my interim dividends. When I see dividends in my nominal account section, I know that's my interim, and that's my 21.6 here, 21,600. And the last one that I need is my final dividend. So I'm going to come here and say final dividend here, final dividend. How many shares? They said a final dividend of 2 cents per share was declared on 28 February. The shares repurchased do not qualify. So the share capital consists of 2 million. So we had issued 2 million, that is the 1.2 and the 800, 2 million. And then we subtract the 12,000 that were repurchased. That would then give me my number of shares for my final dividend, which is, okay, let's see, that's that, and then the shares repurchased. So let's see if I do that, final dividend. So I'm gonna come here and I'm going to say from the 2 million, we are repurchasing the 12,000 minus the 12,000. So that's going to give me 1,988,000. Then I give 2 cents of that, and that's going to give me 39,760. So I simply said, then I get my 39,760. Okay, let me show you again what we did. We said out of the 2 million shares that we had in issue, we repurchased 12,000, and that will leave us with 1,988,000. And then we are going to give 2 cents, multiply by 0.02, and that is how we get that one. Then eventually we get the balance at the end, which is going to be a 2,013,548, like that. Okay, so I'm going to stop here with this question because we're going to start a new one now. And I know most of you have challenges with fixed assets. So what I want to do, I want to begin doing adjustments that have to relate to your fixed assets, so that whatever adjustments that you need to make in your income statement, you can do that. Statement of comprehensive income. Whatever adjustments you need to make to your statement of financial position, you can still do that. Even the topic that is to come, cash flow statement, we can still be covered in all aspects. Okay, so here is activity number 2. And here's the information that relates. And then it says, calculate the amount of land and buildings purchased. So that is what we want to do. We can see here on our cost, land and buildings, this is at the beginning. It was 1,820,000. But at the end, it has increased to 2 million. So how much of land and buildings did we add? Extensions to land and buildings were made during the year. So we want to know how much was spent on that. So I'm going to say my 2,049,700. I subtract my 1,820,000, like that. All right. So let's bring you back into the corner again. That is my 2,049,700. My 2,049,700 minus my 1,820,000. That is going to give me 229,700. So that gives me 229,700, like that. Okay, that becomes the answer for number 1. Additions, 229,700. Okay, let's come here, calculate the proceeds from fixed assets sold. Okay, so we have sold the fixed asset. It said equipment with a cost price of, we don't know the cost price of that equipment, and accumulated depreciation of, was sold on the last day of the financial year. It was sold at carrying value on the same day. On the same day, new equipment with a cost price of 125 was purchased. So we want to get the cost price of the one that we sold. There is a number of ways in which one could have done this. Let me take you back to what you did in grade 11. So I'm going to open a quick T account here like this. And I'm going to code this equipment. Equipment, that means it increases on the debit side. On the debit side is a plus, but on the credit side it's a minus. So at the beginning, I had my balance brought down, which was 421,100. That is the equipment that I started off with. Then I added a new one. Let me say we bought it cash. So I'm going to come and say bank. All right, 125. So we added new equipment here, 125. So we can close this now. And we are told that at the end of the year, we are now having 405. That becomes my balance carried down, 405,000. 500. 405,500. So that becomes my balance brought down, 405,500. Okay, so which side is bigger? So if I can add this 2, I can get this one here. How much is that going to be? That's going to be my 546,100. 546,100. So it's 546,100. And then, okay, someone is saying, Mr. Simbi, let's do it together. Let's do it together then. If I come here, I'll say 421,100, which is this one here, plus the 125,000. That is going to give me 546,100, which is what I gave you here. Then I subtract the balance carry down of 405,500 minus 405,500. That is going to give me 140,600. So here, the one that was sold, the asset disposal, the one that was sold is 140,600. That is the asset disposal. Okay, so I'm going to come here and then I'm not going to say, if I had an asset which had a cost price of 140,600, that was its cost, and I know it had accumulated depreciation of 66,650 minus 66,650 on the last day, how much was its carrying value? So we come back again here. It's going to be 140,600 minus 66,650. That is going to give 73,950. 73,950. 73,950. That becomes your carrying value. So the disposed at carrying value is 73,950. Disposed at carrying value simply means what was the carrying value on the day we disposed the asset. That's what it means. Disposal at carrying value. What was the carrying value of the asset on the day we disposed it? That's what it means. So how do you get carrying value? It is simply your cost minus your accumulated depreciation gives you your carrying value, which is what we have over there. Okay, I'm going to move on to the next one. Number 3, calculate the depreciation on vehicles. All right, so remember, when we calculate depreciation, we always calculate for the sum that is sold, old, and the new. But in this case, we don't have a sold. So we don't have the sold. We're just going to calculate for our old. I'm going to bring it a bit up there. So for my old, I know my old, the old vehicle, that is what I'm going to calculate for. So I'm told 918,500. Then I'm going to say multiply by 20 over 100. Then multiply that. So the old is always going to be 12 over 12. The old is always going to be 12 over 12. So it's going to be 918,000. Let's bring you right into the corner. So it's going to be 918,500 multiply by 20%. That's going to give me 183,700. So here I have 183,700 here. Okay, so if I am to get my depreciation here, I'm saying 183,700. Then I'm going to say plus. I need depreciation now for the new, which is my new. Okay, so the new one said it was bought on the 1st of June. Okay, so I'm going to come here and I'm going to say the addition is 140,000. 140,000, that is the new, multiplied by 20 over 100. It's not going to have accumulated depreciation because it's new, so we can't use its carrying value. We're going to calculate on cost on the first year. We're just going to need its cost. Then we're going to say multiplied by how many months. So that is where the 1 June comes very important. So we're going to count from June, July, August, September, October, November, December, January, February. So we're sitting at 9 months times 9 over 12. Let's see how much that is going to be. So it's going to be your 140,000. It's your 140,000. Multiply that by 20%. That is 20 over 100. And then we multiply that again by 9 over 12. 9 over 12. And that is going to give us 21,000. So I'm going to come here. That's going to give us 21,000 over there. So I'm going to come and say plus 21,000 like that. So it's 183.7 plus 21,000. That's going to give us our depreciation for the year there. So let's see how much that is going to be. 21 plus 183,700. That becomes 204,700. So that becomes 204,700 like that there. As simple as that. Okay, so once we're done with this one, I think I'm going to move on to the next one. Can I do the next one? Let's do the next one. I think we still have some few more minutes before we can call it a day. Okay, so let's come to the NSC June for the year 2022. There were some very interesting calculations that pertain to depreciation again. Here it is. And here's the information, but we're going to break it down and start with our vehicles. Okay, so they say, calculate the carrying value of vehicles on 1 March. This one was a giveaway. How do you get carrying value there? You simply say cost minus accumulated depreciation gives you carrying value there. So I'm going to say it is my 2,350,000. Then I subtract my 840,000. That gives me my 1,510,000 like that. Okay, let me move on to the next one. Can I do so? Let's do that. Okay, so the next one, calculate the total depreciation on equipment. So remember, we calculate for our son, sold, old, new. Additional equipment was purchased. That's the new. Equipment is depreciated at 10% on cost. And we don't have the sold. So let's start with our old. It's on cost. So like I said last week, when I'm calculating depreciation on cost, I have to be very careful that I'm not being tested on the R1 residual value. So I calculate depreciation, then I look and see, am I not being tested on the R1 residual value? So what I do is I take my cost, which is my 640,000 there. So I'm going to say 640,000. Then I'm going to say multiply that by 10 over 100 and then times 12 over 12. That will give me 64,000. Now, I carefully look. Is my 64,000 greater or lesser than my carrying value? My carrying value is 28. So that simply means my depreciation is greater than my carrying value. When that happens, when your depreciation is more, when your depreciation is greater, when your depreciation is higher than your carrying value, you simply don't consider that depreciation. And then you take your carrying value, which is 28,000. You subtract R1, and then you get your new depreciation amount, which is 27,999. I taught this in last week's class. That is, the moment you realize that your depreciation is higher than your carrying value, you can't depreciate an asset beyond its cost. In other words, you can't have a negative carrying value. And I remember breaking it down nicely last week. So I want to encourage you not to miss a single class so that you can follow up with what I'm doing over here. So once you see that, like we see here, our depreciation is 64, yet our carrying value is 28. That cannot be possible. We can't lose more than what we have. So what we do, we take that carrying value of 28, we subtract R1, therefore that gives us depreciation for the old. Then we come now to the new. To the new, we are now saying the new is 195,000. The new is 195,000, and we're going to say that 195 multiplied by 10 over 100. When did we acquire this one? It was acquired on the 1st of October 2021, and remember it's ending on 28th February. So we're going to count from October, November, December, January, February. That is how many months? 5 over 12 times 5 over 12 like that. And then I'm going to say 195,000 multiply by 10 over 100. 10 over 100. Then we multiply that again by 5 over 12. 5 over 12. And that gives me 8125. So I'm going to get here my 8125, like that. So I'm going to add my 27999 plus my 8125. That's going to give me my total depreciation. Let's do that together. That is 8125 plus 27123, like that. That's going to give me 36124. 36124. 36124. All right, let's go on now. I think this could be the last calculation for the day. All right, and let's see what they want us to do. Carrying value of the vehicle sold. So in this case, we have a vehicle that was sold. It says, an old vehicle was sold at carrying value on 30 November. The cost of this vehicle was 252 and its accumulated was 172. Vehicles are depreciated at 20% per annum on the carrying value. So we know that this vehicle had a cost which is 252, and if I subtract its accumulated depreciation, which is 172, I will get its carrying value, which is 80. But I know that we did not dispose it on the first day of the year. We used it and we disposed it on 30 November. So that simply means that was not its carrying value on the date of disposal. We still need to calculate depreciation. Now, to calculate depreciation, I'm going to say it's calculated on carrying value also. So I'm going to say my 80,000, which is my carrying value, 80,000, then I multiply that by my 20%. So I'm going to say 80,000 multiplied by 20 over 100, multiply that by how many months? We're going to count from the beginning of the year, which is March. So it's going to be March, April, May, June, July, August, September, October, November, which is going to be your 9 over 12. 9 over 12. All right. So we're going to say 80,000 multiplied by 20 multiplied by 9 over 12. Okay, 9 over 12. Let's see if that's going to come up. That's going to give us 12,000. That is our depreciation. Okay, so our depreciation is 12,000. That simply means out of this carrying value of 80, I must still subtract my depreciation for this year minus 12,000 again. That is going to give me now the carrying value on the date of disposal. So it's going to be 80,000, which is carrying value at the beginning, minus the 12,000 depreciation for the year. That's going to give me 68,000. 68,000 is the carrying value on the date of disposal. That is how we will do this particular calculation. Okay, so the trick was, when you're given carrying value at the beginning of the year, you still have to subtract the depreciation for the year to get the carrying value at the date of disposal. That's what I was trying to drive at in this particular activity. Next week, I'm going to start something new, something different, because we've done, I think, statement of comprehensive income in 2 weeks in a row. So make sure you join next week's class. Tell a friend to tell a friend that we are here and class start exactly at 2. And then we hope to finish around this time. It is very important that you remind your teacher to give you the worksheet. If they are not giving you, just ask them. If they don't have the printed copy, just ask for the soft copy so that you can be seen as we work together. It is very interesting that we get to calculate when you can see the figures right in front of you. Until next time, enjoy your studies and goodbye.